Good afternoon. I'm David Luberoff, the Joint Center's Director of Fellowships and Events, and it's my pleasure to welcome you to today's Housing Research Seminar, which will feature a talk by Leonardo D'Amico, a PhD student in economics here at Harvard, who is one of our Meyer doctoral dissertation fellows. Before I introduce Leonardo, let me just highlight a couple of upcoming talks as part of our quite busy spring semester event series. So next Wednesday, February 26th, we will be having a panel discussion on what Boston can learn from Zurich's co-ops. Presentation by Suzanne Schindler, a research fellow here at the Joint Center, who has a new book about Zurich's long history of co-ops, about 100 years, and then a panel discussion with people from the public, nonprofit, and for-profit sectors here in the Boston area about what we might learn from their long history. That'll be at 6:30 p.m. Wednesday, the 26th, at MIT's City Arena, which is in the Samuel Tack Lee Building, 105 Mass Ave. For those of you who know the MIT building system, I believe that is Building 9. 2 weeks from today at 1:15, Whitney Airgood-Obricki, one of our research analysts, senior research analysts, will be talking about the state of the rental housing market. That's essentially an update on our America's Rental Housing Report, which came out about a year ago. Whitney will be talking about what the most recent data is telling us about the rental housing market. We have many, many more events in March and April. Excuse me. Look on our website and follow our emails to hear about them. Everything from social housing to homelessness to disaster response, really touching a lot of the key issues in America today. Now on to today's event. Our speaker is Leonardo D'Amico, a doctoral student in economics, who is also a Meyer doctoral paper. He'll be focusing on a paper co-authored with Maxim Alekseev, focused on the factors that drive the integration of national financial markets and their consequences for regional growth. He'll tell you a really interesting story about the US, and then also explore some of those implications, not only for the US, but actually they're particularly interesting in the context of the European Union. Leonardo will speak for about 30 to 40 minutes. We'll take questions, which hopefully you will be submitting through the Q&A feature. Apologies in advance if we don't get to your question, but we will share them with Leonardo and Maxime, who is also online with us and available to answer some methodological questions. A video of this event and slides will be posted by early next week, and the paper will soon be published by the Joint Center as one of our working papers. Leonardo, it's all yours.
Thank you, David. Thank you so much. Thank you for having me. It's really such a pleasure to be able to share our research with the broader Joint Center for Housing Studies community. So I'm gonna share my slides and talk with you about capital market integration in the United States. Okay, so, sorry. Okay, so let me start with the motivation for this work, which is, as David had said, I'm going to try and bring us back to a period of US history between the mid-1950s to the mid-1980s and try to understand what are the lessons that we can draw for today from that period. And so let me start with the motivation for this work, which is the idea that if we look at American historical development, especially on a more long-run perspective, this is a story characterized by two parallel processes that were going on. One is the rise of large and deep national financial markets that reallocated savings from areas with excess demand. Think about, the old Northeast to areas, the excess supply to areas with excess demand, so the up-and-coming Southern West. And there is a very large historical literature that tells the story of how these financial markets enabled capital to move and fund, railways, gold rushes, and in general, whatever economic opportunity, wherever it arose. Parallelly, there is another literature that studies how workers have moved across the same geographic lines. America is a story of moving west, of workers moving to opportunity, increasingly so. And these two processes have been usually treated as parallel but distinct. America moved west in terms of labor and in terms of resources, but the two processes were roughly treated distinctly. What we try to do in this paper is asking whether the rise of national financial markets actually helped causing and at least explaining part of process number two, meaning the movement of people. And so to answer this question, so to answer the question of whether the movement of financial capital itself enabled the movement of people and affected growth across the United States, I guess we're thinking of going it in two steps. The first step is really trying to understand what are the drivers of geographic integration of financial markets, why these markets why these markets grew at certain point in times, but they didn't at other point in time, so that once we understand what drives integration of financial markets, we can use this driver to study the real consequences on growth, asking the question of how does the mobility of financial capital that this sort of geographically integrated financial markets allow ends up shaping regional growth. And the setting in which we study this question is the US banking market, is the US economy at a time in which banking markets were segmented across a state line by regulation. In particular, this is a time of US history between 1953 and 1982, in which banks could not branch outside their own state. So it's a very different setting from today, where large US banks can source a deposit from someone here in Massachusetts, lend it out in Arizona just with a keystroke. At the time, banks could source deposits only in the states in where they were operating, because they had to source it through branches, and were basically lending mostly in the states in which they were operating. This setting ends up being quite a good setting to answer these sort of questions. And then we're going to move, and this is especially, I'm going to have a little bit of that today, but it's mostly in the paper, on what are the implications of these findings for today. And I'm going to try to draw two main lessons of this period of US history. One is for current context, where financial capitals are not as integrated in the US. In the Eurozone, we don't have large European banks that are in every member state and can move deposits frictionlessly, and also try to draw some implication for current US place-based investment subsidies, because the paper is going to show that financial costs are a major driver of growth at the regional level. So let me give you the plan of the paper and the contributions that we do by studying this period of US history. The first part, that we start by digitizing new state level bank data. So we find this by digitizing all the reports of the regulator of banks, the Office of the Controller of the Currency, which allows us to shed light on some new data that shows two things were happening in this period. This is a period in which regulation did not change, but yet markets moved in a substantial way. So on one hand, we find evidence of substantial financial integration. We find that differences in interest rates narrowed over time, so prices converged, and also that banks started relying much more on these national markets in order to fund their loans. And then beyond that, in terms of real consequences, we find that those places that were at the beginning of our period, the capital scarce, in which the banking sector did not have as much capital as their peers in the Northeast, or those that grew the most over this period. And these are the places that both benefited from an inflow of financial capital and also seem to be correlationally growing the most. And so the paper wants to start from these two facts and link them together. The first is going to explain why financial integration seem to have happened during this period. Why we see this narrowing of differences in the cost of a loan, which is suggestive of facts that markets are getting more integrated. And then why do we see that banks started relying much more on these national markets as opposed to only local deposits to fund their loans in this period? And here we're gonna have some new theories of what drives integration of financial markets. And then we're gonna test it and quantify it. And then once we understood the drivers of what drove integration of financial markets over this period, we're going to think at their real effects and try to understand how much of the large heterogeneity in a state level growth can be explained by the fact that financial capital was getting reshuffled all over the US. To do that, we turn to a quantitative model that allows us to model growth across regions in a fully quantitative way, takes into account the fact that people move based on the expected path of wages, housing costs, amenities that they have, and also that capitalists invest in machines based on how much money they think they're going to get out of that. And so, but to that, we add banks to this model that allows us to jointly model the frictional mobility of financial capital across space and the frictional mobility of labor. And so this allows us to show that the reshuffling of financial capital over this period can explain up to a fifth of why the South and West, which benefited from this reshuffling of financial capital, grew more than the average US states, and can explain why the Northeast, who lost its part of its advantage as being the capital-rich hub of the US, because now capital was more mobile. It explains why the Northeast, the northern financial centers, were relative losers in this period and lost some of GDP and population growth compared to the average. So we're slower in terms of GDP and population growth compared to the average state. Then we're going to think in the paper, not today, at the aggregate effects on the US economy. What is the aggregate effect on TFP once you realize that this is moving some people around and financial capital moves around? And then we're going to draw the implications. I'm going to touch upon the implications briefly today, but in the paper we have much more. So start with the fact that the talk is gonna first go through the main new facts that I was telling you about this period, and then we're gonna go to the theory and I'm gonna show you what we do to the theory and then talk about the implications. So the setting in which we work is, again, the American banking system before the regulation. And I want to give you three sorts of important things to keep in mind about this setting. Two are regulation. One is that this is a moment of US history in which banks are prohibited largely from branching outside of their own state. So all of their branches have to be within their state. In some states, they have to be within their city, in the city of the headquarters. In some states, you just cannot even have branches. And then there is, whereas another part of regulation, which is important in our setting, which is that regulation Q capped interest rates on deposits, meaning that banks that wanted to offer some higher interest rate on deposits, they couldn't because regulation Q prevented them from doing so. For instance, checking accounts were prevented at all from paying any remuneration. Another important feature, which is not particularly important for the qualitative conclusions of the model, but is going to be important for the quantitative conclusions, is that most commercial lending at the time was short-term. So banks are a very different animal at that moment in time than they are for today. 62% of their loans to corporations had a maturity of below 6 months. So I want you to think of this banking sector as, in terms of real activity, funding mostly working capital for firms that need to produce, and they need to wait some time before they can sell, and they need to finance that production. The data that we use to study this setting comes from the state level, comes from the reports filed by the Office of the Controller to the Currency, of the Controller of the Currency, the Supervisor of Banks, to Congress. So these reports have state level banking data. So they contain data that tells us how what were the earnings, the costs, the liabilities and assets of banks in a given state. And so this is a good panel to study banking evolution at the state level, and we do it, we digitize it for all state for 1953 to 1970. From 1960 onwards, we have also bank level data that we retrieve using a Freedom of Information Act requests between 1960 and 75, and then from 76 onwards they're public. This gives us the same information as the OCC reports, but at the bank level, not at the state level, so it's even more granular. We have a 10-year overlap to be sure that the two data sources are consistent with each other, that they are, and roughly they are. But I want you to think of this as giving us a panel of liabilities, assets, income, expenses, reserves that banks had at the state year level. So what do we do with this data? Well, the first fact that we show is that markets seem to be quite segmented and then seem to become more integrated. Now, I keep using these segmentation and integration terms, but of course, it's hard in the data to actually measure in segmentation and the degree to which markets are integrated. So I'm going to resort to the idea that if markets are integrated, well, the price of one good should be the same, right? So if two markets are integrated into an actual common market, well, then the sellers of the same good of those two markets should have the same price. That's the definition of integration. So the paper is going to use price differences across space to discipline our idea of how much markets become segmented or become more integrated over time. And so let me start from the 1950s. And by plotting the local interest rate at the state level as a difference from the average US rate. So if we look at the map, this is a map of the lending rates in the US in the mid-50s. And what we see is that lending rates, bank commercial lending rates, were much lower in the financial centers of New York, Chicago, Massachusetts, and they were much higher in the remoter part of the US. The spread, the difference in lending rates across space is roughly 1.8 percentage points. So it's not a small difference, especially over a base of like 4 to 5 percentage points of interest rate. What happens in the 20 to 25 years that follow this, however, is that states that were initially high lending rates became cheaper over time, as if they converged to the mean, which can be interpreted, among other things, as markets becoming more integrated. In particular, let me just give you the data. In the data, if we look at the change in interest rate between the initial period, 53, 58, and then the average interest rate in the post period, 59 to 83, and we regress it on the initial interest rate in 53, 58, we find a very negative slope with a coefficient of 0.54. The way to read this is saying, well, a state that had a 1 percentage points higher interest rate in the 50s is converging to the mean by 0.54. Now, of course, this beta can be the outcome of markets becoming more integrated, in the sense that, if we had two different prices and now markets start trading more with each other, they get more integrated because it's easier to trade across space, well, these prices are going to convert. The differences are going to be eroded. There's going to be someone in New York that will increasingly start lending in Arizona, which will bring up the rate in New York and bring it down to Arizona. However, and so that they converge. However, it could also be that this narrowing, this negative beta is coming from so many other things. It could be actually, that maybe what we're picking up in the 50s is not differences in the supply and demand of local capital in different states, but it's also that it's only that, Arizona maybe is just riskier than New York. And that's why interest rates are higher. It's just we're not accounting for risk in a good way. And so that's why interest rates are higher in Arizona. Or it could be that, there is some shock that I am capturing in the 50s. Arizona maybe had a bad shock. I'm keeping Arizona as an example, obviously, but this is one of the red states with a high interest rate. Arizona had a bad shock, and this shock is just a temporary fluke, and it's gonna revert to the mean. And so this beta is not traders that are gonna trade with each other more. It's just, mean reversion. So this is to say there are so many possible explanations for this beta. So the first part of the paper really is trying to show that part of this beta, it's going to be that 90% of this beta actually, comes from markets becoming more integrated. So banks trading more with each other, New York bank trading more with Arizona banks, and people saving more on national market rather than keeping their money locally at their local bank, and this spurring financial integration. This is going to be the objective of the first part of the paper. Show you that this beta is not some fluke in the data, but it's actually something that reflects markets becoming more integrated. The second part of the paper then is going to use the fact that we have understood what drives this beta in the data to understand its consequences on growth. So I give you the other fact that allows us to understand where is this beta coming from. And in particular, what we're going to do is we're going to unpack this beta over time and try to see, instead of looking at just the average change in interest rate between the post period compared to the 53-58, we're going to look at the change in interest rate between year T and 53-58, all between throughout our sample. So, and then what I'm going to plot here is the beta from repeated cross-sectional regressions of the change in interest rate between year T and 53-58 against the initial interest rate in 53-58. And so the way to read this beta T is, well, by year T, how much a state that at a 1 percentage point higher lending rate is narrowing toward, is going back to the average. And so a high, I'm plotting the negative of beta. So a high negative beta is going to mean a lot of integration. So a state that at a 1 percentage point higher rate is with a negative beta of 1. It means a beta of -1. It means that it's converging to the mean perfectly. At 0 means that it still stays a high rate state. But the average of this beta over time is going to be the same beta that I showed you before when I took the average change in interest rate in the post period against the initial period. But its path over time is going to be informative of what's going on and what's driving this beta. So this is the path of the betas that we find. The way to read this is that a state that at a 1 percentage point higher interest rate in 58, let's say in 53-58, by 1969 is converging to the mean by 0.7. Meaning I had, let's say, 4.5% interest rate, the average was 3.5. Well, 70% of that difference has been eroded by 1969. So I'm better off because I started off very expensive as a state and now I'm better off. However, what's quite surprising about this series is that if we look at 1970, 71 and 72, well, it seems that, these differences across space open up again. The state that was 1 percentage point more expensive is becoming again more expensive because this beta drops almost to 0. And then it goes up again in the 1773 and 74, and then it goes back down to 0 again. So it seems that, this process of integration, the speed at which these differentials are narrowing is really not monotonic and not secular. In particular, what is really peculiar about this series and surprising ex ante is that if we overlay the level of the nominal rate, these two things look almost one-to-one. When the nominal rate is high, states that at a 1 percentage higher lending rate ex ante are converging to the mean, they're better off. When the nominal rate is low, the initial differences are opening up again. A state at a 1 percentage point higher lending rate is again becoming more expensive, even though in years of high nominal rates in the past, it had become cheaper. And there is nothing mechanic ex ante among these two relationships. These are repeated cross-sectional regression. We're just seeing how much states converge or diverge in years of high nominal rate. We're not looking at the average level of their interest rate. So there is nothing mechanical linking the nominal rate to the differences in rate across states. And so the paper tries to develop a theory that explains why an increase in the nominal rate can actually foster financial integration, can foster the fact that differences across states in the availability of capital are narrowing in years of high nominal rate, but then are opening up again in years of low rates. The intuition behind the theory, which is going to be the core part of the first part of the paper, is going to be the core result of the first part of the paper, is that nominal rates can be a powerful driver of financial integration because they lead households to move their liquidity from funds that they keep at their local bank, their bank locally, to money market funds or other sort of investments that are on national money markets. And then these money markets are redistributing this investment again across places, but in a place blind way because these money markets are national. In other words, when nominal rates are very high, households want to protect themselves from inflation. And so they take away their money from their unremunerated checking accounts to their local bank. They move it to national money markets, and then these national money markets redistribute it across space. And so lead to financial markets becoming effectively more integrated in years of high nominal rates. To see it in the data, what I'm plotting here on the left-hand side is the fraction of funds that households were holding in national money markets. Think about as like money market fund shares, large checking time deposits, commercial paper. These are all things that households were buying either directly or indirectly through intermediaries, but that were securities issued by private corporations on national money markets. These money markets, just in terms of jargon, or markets that are, they're offering a very short-term securities, short-term bonds that pay the short-term rate. Think about the 3-month T-bill rate, and are very liquid. So that's why they're quasi-money. That's why they're called money markets. And so this share of national market holdings as a fraction of income is in the black line of households. And as you can see here on the green line, I correlated. We were putting the rate on the 3-month treasury bill. This is also money market security. So this is the nominal rate for us. And these two things are correlated almost 1-for-1. And it's not that surprising. And it is the story that I was just telling you before. When nominal rates go up, well, households want to protect themselves from inflation, and so they start buying these money market securities instead of holding their money locally at the checking deposits. What we show on the right-hand side is that as the money from households was moving from their local bank to these national money markets, well, these national money markets were putting the money back into the banking sector because banks had to start relying much more on these national sources of financing rather than relying on their local deposits. In the right-hand side panel, we are plotting how much banks were relying on national sources of funding. This can think of the Fed funds, repos, time deposits that were negotiable and issued on large markets, rather than sources of funding from their retail sources of funding from their local households. One example, for instance, is that if we think at checking accounts, they make roughly 80% of banks' liabilities in the 50s, meaning 80 cents of every dollar of a loan that the bank makes is funded with a checking account, with an account from a household local to the bank. However, by 1982, these checking accounts make not even 30 cents of the dollar, because banks are starting to borrow much more on national markets. They need to issue Fed funds, they need to borrow from the Fed markets, they need to issue time deposits, because households are not happy anymore to hold their money in checking accounts that pay nothing. However, this move from local stuff to national is what drives and gives power to our channel of financial integration. So then let me shift gears towards the fact that give rise to growth, which is once we've understood the drivers of financial integration, and I'm going to have a model very soon that kind of formalizes this point that I just made. But before going to the model, I just want to give you this spoiler on why should we care about this movement of financial capital. I think why should we care is that at the same time, we find that those states like Arizona, Nevada, those states that have high interest rates that are benefiting from this convergence are also those that are growing the most over this period. Here, what I'm plotting is GDP growth on the y-axis, real GDP growth against between 63 and 83. 63 is the first year we have GDP data available, against the initial interest rate in 53, 58. So what you find is a very strong relationship between initial capital scarcity, as measured by the initial interest rate, and subsequent growth. It seems those states in which that became relatively cheaper relative to the average state are also those states that have grown the most over this period. And this is true both unconditionally, but also if you control, and in particular, this is where what we're controlling in this picture, for the usual other drivers. We know that this is a time in which people move to warm places because air conditioning is getting commercially viable. And so we control for January temperature, which is the way that people have thought of controlling. We control for sectoral and agricultural demand shocks. These are places in which some states go through large boom and bust cycles of crop prices. So we control for that by looking at which kind of crops they were growing and how the prices evolved in the international markets. I apologize. And then we control for right to work states, because this is a time in which factories move towards more states with fewer labor protections. And then the GDP in oil because of the inflation. But even if you put all of this control, even if you look only within regions, so you compare New York to Connecticut instead of comparing New York to California, you still find the strong relationship between initial interest rates and subsequent growth. And then another core surprising fact of this relationship is that if we looked at whether this relationship was driven by population moving, so GDP is higher because there's more people moving, fixing the wages, or wages, so GDP is higher because the same amount of people are there, but their wages are not higher, we would find that all of the migration, all of the growth is coming from population growth mostly, and not from GDP per capita. And in particular, the population growth is all coming from migration of people from those initially low rate states that have lost their advantage to high rate ones. And so what we want to do in the model, in the theory part of the paper, is try to clarify two things. Try to build a model that allows us to quantify and clarify two things. One is the role of nominal rates in driving financial integration. We want to have a model that allows us to square why states become more financially integrated when nominal rates are high. And in the paper, we show that other traditional stories really cannot explain the path of integration that I just shown you. The second objective of the model is going to be that we want to have a role of we want to explain how does this financial integration, the fact that now New York loses its advantage compared to Arizona because people are not happy to keep all of their money locally in their banks, can drive population growth. And this is different from the conventional way we've thought about capital market integration, which usually is about investment of the capitalist. Here, though, we're thinking of integration of capital markets within a country in which financial capital moves within the country. But within the country, also labor is mobile. And so that's why we're going to have all of these effects on labor rather than on wages. So the ingredients of the model. So now in this second part of the talk, I'm gonna quickly go through just the main ingredients of the model. There's gonna be no equations or stuff like that, but we do have all of that in the paper and very happy to talk about it. But just for brevity, I'm gonna give you just the intuition of the model of how it's going. And then the model allows us also to draw the policy implications. So let me give you the ingredients. We're gonna think at a setting in which we have many regions, in which there's banks, firms, and households, and we're going to work in continuous time. There's going to be two types we're going to solve the model in two ways. First, we're going to think at within each period, at a choice that households make between holding their money, how they want to store their liquidity, and whether in deposits or in short-term bonds. And then firms are going to have to borrow from the bank or from national money markets in order to pay their inputs before they sell at the end of the evening, at the end of the sub period. And then across periods, we're going to think about people moving because of the wages that they face, because of housing costs, because of amenities, and investors investing based on the rental rate of capital they expect. So the timing of the model is going to be a model in which firms are going to we're going to think of each period as having two subperiods. One is the morning, in which the region wakes up, there's some workers, there's some capital. The firms has to pay the workers and rent the capital to produce. What we're going to assume is that this firm pays the inputs in the morning, produces and sells in the evening. And so we're going to assume that the firm has to finance some of this production in the morning with the bank. This is the role that banks play in the real economy. They give some money to the firm, they lend some money to the firm to have the time to produce up until the firm arrives in the evening to sell the good and then gives back the loan to the bank. We're thinking about a safe loan, not thinking about risk. Households, instead, they have the opposite problem. They consume in the evening, but then they get their wages in the morning. So they need to decide whether to hold their liquidity in deposits or in bonds. And the difference is that these deposits are gonna give these households a liquidity benefit that could be idiosyncratic across different households. You know, I might not like too much to go to the bank, but you know, other people like it a lot, and they like talking with the clerk, and so they have higher benefits from holding their liquidity in the bank. And the bonds we're gonna assume that these short-term bonds, they always pay the nominal rate of RT. So banks are going to intermediate these financial constraints. They're going to get the liquidity from households in the morning. They're going to lend it out to the firms, and then in the evening they're going to clear the financial flows. So let me give you just a representation of how an increase in the nominal rate, which is really the objective of the first part of the model, can explain financial integration. In particular, we're going to think of these households, the bank and the firm. And let's start from a low rate environment in which households are happy to keep all of their money in deposits. You know, nominal rates are 2%. There's not much from going to the money market, and I'm happy to keep the money in the deposits and enjoy all of the liquidity services that the bank gives me. We're going to think of two regions, abundant and scarce, that differ by the fact that in abundant, firms don't need to rely on the bank that much. Think about this, are the New York firms. They're large, they have access to bond markets, they have a lot of internal retained earnings. They don't need the bank as much. So really, banks have a lot of deposits in these old regions, and they don't have much loan demand. And so they can really mostly finance all of their loans, almost, just using the deposits. Think about instead in scarce, it's an up-and-coming region. The firms are very small. They don't have much internal capital. And so they actually really need to rely on the bank a lot. You know, the arrow between the bank and the firm is much larger in scarce than it is in abundant. And so here, banks in scarce, the deposits in scarce are not enough for all the loan demand. And so they have to pull in a lot of liquidity from the national money market. We're going to assume that for banks, it's much cheaper to lend on deposits than it is to lend using money market instruments. This is going to be a key friction in the model. Lending using deposits is much cheaper than using bonds for the bank. In particular, it is increasingly costly for the bank to use to use bonds. So this is just to say a bank that borrows 90% of its liabilities from other banks or from the money market is much more expensive to operate compared to a bank that borrows only 10% of its liabilities. That is going to be the key implication and the key assumption. And so the implication of this assumption is that because scarce has to pull a lot of liquidity from national markets rather than just rely on its households with this cheap amount of deposits, well, it has to pay a high marginal cost, which drives up its lending rate. So this means that lending rates in this example are going to be higher in scarce than they are in abundant. But now let's think at what happens when nominal rates goes up. Let's now think that inflation goes up by 8%. We are in the 70s or in the early 80s. And inflation goes up even to bringing nominal rates to 13, 14%. Well, now households have on one hand a deposits that pays 0. It gives me some liquidity benefit, but that's it. And some nominal bonds that pay 13%. So households are going to move their liquidity to national money markets. So deposits outflow, the arrow moves from the bank to the national money market, but this really hurts abundant much more than it hurts scarce. Well, abundant has lost all of its funding. All the banks in abundant were relying fully on deposits and now start relying fully on the national money market. Whereas banks in scarce, they didn't have many deposits to start with as a fraction of loans. And so, yes, they lost the deposits they had, but that wasn't really their thing. In other words, abundance advantage over scarce was having a lot of deposits to fund their loans. When nominal rates go up and inflation goes up, this erodes abundance advantage over scarce and leads to an equalization, a leveling of the playing field. Now, banks in abundance, they don't enjoy the rent of having so many deposits over scarce. And so that's why abundant loses its advantage when nominal rates go up. Funding differences between the two narrow. Now they both have to compete with T-bills and borrow from the same national money market in similar amounts. And so in this way, the lending rates are gonna narrow. And this is what gives rise to the path that you've seen in the figure in which we were looking at the speed of financial integration and the nominal rate. There's all the bells and whistles in the paper and all the extensions and this is an example in which, things are kind of uniform, but the model is more ambiguous in some other cases, and we have all the conditions in the paper and the tests of those conditions. What we see quantitatively in the data is that 50% of the narrowing of regional differentials comes from banks, from the increase in nominal rates. The fact that nominal rates have moved deposits to national money markets erodes 50% of the differentials. But then we also find that banks were also getting better at trading with this national money market. And so this technological development, think about the fact that, banks are learning how to use these money markets, how to use this source of national financing. This technological development is also important. Together, these two sources, the nominal rate and technological development, explain 89% of the beta that I just showed you at the very start of the paper. And so here, the advantage of this is that we have found financial sources of financial integration that depend on the bank sector. They don't depend on the real side of the model. And so we can use these sources to understand what happens to growth. This is what the second part of the paper does. I'm just going to give you the stripped down intuition of how things work, which is that the idea is that banks affect the real economy because they affect how firms, the cost for firms to produce, because firms have to hire real factors, but then they have to pay on top of that a cost to the bank. And so when lending rates are high, firms are going to have a low capacity to pay high wages or high rental rate of capital, because a lot of the chunk of their productive ability, they have to pay to the bank to pay for the loan. And so this is gonna give a channel through which lending rates are gonna affect wages and the return from physical capital. Households or the migration, the choices of households is that households decide where to go. They enjoy amenities and consumption, pay housing costs. And here what the point is that when Arizona's interest rates converge to New York, Arizona's wages are gonna go up more in Arizona than in New York. And so this is gonna attract people in Arizona. Similarly, a physical capitalist, when interest rates go down in Arizona compared to New York, the physical capitalist in Arizona is the firm in Arizona can pay higher rental rate of the physical capitalist because now it pays fewer costs to the bank, so it's going to increase its production. And this is going to lead the physical capital to invest more. There's going to be two assumptions that I want to discuss. One is that we don't have any household borrowing. And this is because in another paper with Victoria Angelova, we find that mortgage rates were already integrated by the time, by 1940 because of the creation of Fannie Mae and the FHLB. And I'd be very happy to also talk in the Q&A about that. And so we don't have any roles for mortgages driving household choices. And then the other thing is that the migration is short, the firm borrowing is short term. The exercise that we're gonna do, and this concludes the theory part of the paper, and then I have just one slide on implications, is that the shocks to nominal rates, we're gonna feed to the model the shock to nominal rates and frictions. We're gonna think of the US economy as being in sort of, so to speak, a steady state in which things were like constant before our shocks in the 50s. And then we're gonna shock the economy. We're gonna, have every state in the model. We have New York, California, Arizona. we're going to shock the model with the increase in the nominal rate and the fact that banks are getting better at trading with each other. And what we want to look is how population evolves in New York, Massachusetts, Illinois, compared to the states in the West, and how physical capital evolves as financial capital moves. So financial capital moves, we've seen it in the first part. Population and physical capital, we see it here. The change in population, New York loses up to 6 percentage points of its share of to 6% less growth compared to the average US state. Of course, as a share of population. The population in total, New York keeps increasing, but as a share, New York is shrinking. And Arizona, the states in the West, that now benefit from the fact that these New York deposits are increasingly going to Arizona. They benefit and they grow more. And same thing with physical capital here on the right. So taking stock and heading to the conclusion, the idea of the paper is that high nominal rates are a powerful driver of financial integration. And then financial integration can have important consequences on growth. I guess the implications for policy today is that cheap financing is important for regional growth and can have sizable spatial consequences. I think this relates to the current debate on the implications for current place-based investment policies. The other conclusion is that removing barriers to the mobility of capital is more effective in low-rate environments. The reason is that the regulation allowing banks to move capital across space with branches, for instance, what happened in the US in the 1980s when we stop our sample. Well, this is much more important if there's a lot of deposits to move. So if deposits are a large share of banks' balances, well, allowing a bank to move them around is very important. But if nominal rates are very high and deposits are not a very important share of banks' liabilities, well, then the regulation is much less powerful. So what we find quantitatively is that removing the restriction on branching would have been twice as powerful if this had been done in the 1950s rather than in the 1980s. So let me conclude that what we do is we study the mobility of financial capital jointly with the mobility of labor, and we find that financial integration, the fact that financial markets became more integrated, can explain part of America's move to South and West. Aggregate rates can be a powerful driver of financial integration, and the regulation is more powerful when interest rates are low. This has implications especially for the Eurozone, because the Eurozone would deregulate coming off of a low-rate environment, whereas the US, when they deregulated, was out of a very high-rate environment. When US branching loss deregulation happened, well, it was the 1980s when interest rates were 13 to 15%. The Eurozone has come out of a much lower rate environment. This is part of a broader agenda in which we are trying to think about integration of capital markets and real growth. And in particular, we have also this other paper with Victoria Angelova in which we look at the integration of mortgage markets and how the creation of Fannie and the FHLB allowed a lot of mortgage capital to move from the Boston of the US to the Dallases, and this spurred growth in the South and West. And with that, let me conclude and turn it up to you for questions, and which I'm happy to engage.
Leonardo, thank you. This is really an extraordinary piece of work, and I think I remember when we saw the original grant, and you were talking about digitizing decades of banking records, and we were stunned, and I still am. We have a couple questions coming in, and I do encourage folks online, if you've got some questions you'd like me to pose, feel free to go ahead. But I'll start with what we've got and a few of my own. A core piece of your argument, right, is that the financial convergence, along with some technological changes, particularly the rise of air conditioning, are a huge piece of understanding the growth of the Sun Belt. What's your sense of what happens going forward? We have air conditioning, and we are in a world of financial convergence. So does that suggest something different in the way some of the Sun Belt states would grow, and some of the Western states?
Yeah, no, thank you, David. I think that's exactly one of the points we want to make. We want to make the point that, if we think at the growth of the South and West in the US in an historical perspective, a new driver of this growth that we hadn't thought of as quantitatively as we try to do is the fact that, financial capital became cheaper. Then there's all the other stuff that we've thought about, air conditioning, railways, right to work, all of the other stuff that we know. What we say is that financial capital being more cheaply available also has played a role. This implies also that perhaps part of the growth post 1980s was due to the fact that branch in the regulation allowed now even more financial integration because, compared to the one we have, because now New York banks could put a branch and then move their deposits quite frictionlessly almost. Now, what does imply going forward? Today, US markets are completely integrated, I think, geographically integrated. Banks have branches everywhere. However, it says that the quantitative results of the paper say that when we think about helping regions in distress, which does not necessarily have to be the South and West, but if you think about helping regions in distress in the US, well, this sort of like subsidies to investment, subsidies to financial capital may have a quantitatively non-trivial role. So I think there's just much more to do there, but the paper offers a way of thinking about these subsidies in general equilibrium. When you think of the fact that when you think about the subsidy, you want to think that a dollar that comes to a place is coming from somewhere else. And so you want a model that tries to aggregate that in spatial equilibrium.
I was struck, and you're, I'll stipulate that you're a much better modeler than I am, but it looked eyeballing that some of the effects you found of the places that were most dramatically affected on first glance struck me as places that were particularly at the beginning period, largely white. And I'm wondering if you played around at all with whether race, and particularly initial racial composition, and this might just be because we had a talk yesterday that was looking at some implications about historic patterns of things like sharecropping on current patterns of evictions. So it's on my mind.
Yeah, no, I mean, that's very interesting, David. And we did look at it. We looked at it much more in this paper I have with Victoria Angelov on mortgages. So on commercial lending, it was really on firms. So the job market paper is really on firms. But then when we think about households, we see kind of quite dramatic, actually, differences across racial lines. In particular, what we find with Victoria is we look there at the creation of Fannie and the Federal Home Loan Bank Board, which basically created a national mortgage market, which moved a lot of mortgage, which made it much easier for mortgage capital to move from places in which there was a lot of savings from seniors and very little demand from young people, to places like Dallas and the West, in which there were much more younger people that were demanding mortgages. So what we find is that as this mortgage capital moves from the South and West, it enables those places it moves from the Northeast to the South and West. It enables the places in the South and West, people in the South and West, to have higher home ownership. There's more building, there's increased house prices, people move in. But the result of home ownership is just exclusively driven by whites in prime age whites. There is absolutely no effects on prime age non-whites. I think this is consistent with the idea that part of these mortgage revolutions, which made mortgages more affordable, were actually, targeted not towards everyone, but just towards a part of the population. And I guess this, I've just briefly read from the Q&A one question about inequality. This is, I think, a very important thing to take into account. These policies might help regional inequality, but it's unclear within region what's happening. It actually, the FHA, with not giving loans in certain neighborhoods, actually might have increased inequality within cities, even though it decreased inequality across cities. Now Dallas is better off, but within Dallas, people are more unequal. There is a lot to do, and this is just speculative based on our early results, but I think it's an interesting.
That was in part what one of the things I was sort of thinking about, and I could, we can tell different stories about the standardization and not lending in particular areas. Do you see any, and I don't know if this could show up in your data, any differences in the kind of lending that happens? And I guess I was thinking of a story of it, if I'm going nationally, I've got to sort of standardize how I look at stuff. versus, the old story of, the shopkeeper shows up in the bank and I know David, I know he's going to be good for it. I don't know if the data would let you look at that, and if it did, what you might have found.
Yeah, so it's hard to look at it in the data because we have very coarse categories of loans. So we have loans to CNI, but within like commercial industrial loans, we don't know which kind of loans were banks doing. We don't even know the maturity of these loans. Um, I think there is some work by Dominic Supera, for instance, that shows that as you change your kind of liability structure, he looks at 1980s post. As you change liability structure and you rely more heavily on time deposits and not checking accounts, you start increasing loans to CNI. So there are some these macro categories changes, but there is not as much within each category that we can look at. I think it's much less than you would think based on, for instance, the MBS today and the fact that banks are doing a lot of this kind of buying mortgage-backed securities instead of lending. At the time, it was really there was a lot of like shopkeepers coming up, and I think it was still the case, which is why we think we find these kind of real effects. Is that part of it is this like it helped these shopkeepers having cheaper access to financing. This raised the wages, raised the rental rate of return for machines, and so it led to migration investment.
My sense is, shift gears here for a second, that this period that you're looking at, and then certainly the subsequent period, is my sense is there's a significant share, a growing share of the lending that isn't coming out of the banks that are in your data set. And I'm wondering, one, can you just sort of talk about what's the nature of that change, and are there any implications about how that you would think about both the issues you raised, what is it that the banks are doing versus other key lenders?
Right. So I think, one important example is savings and loan associations. This is a period in which obviously they were very important in providing mortgage financing. And it's a period in which they start struggling, and the period immediately after our sample. So we end in 83 because in 83 there is branch in the regulation. And after that, we cannot really, the data is not useful anymore. Our data, you cannot use it anymore. But this is exactly the period in which, you also start seeing an increase in the problems of saving and loan associations. And there is an argument to be made probably that part of this, so when we think about capital market integration here, we're thinking about growth and we're not thinking about risk, we're not thinking about instability, but there is a ton of work there in an international context. But I think there is a lot of work to do here also in the United States with that period of history of the United States, because it might be that, we paint capital market integration in some sort of like good light, but it might be that it also fueled some of these like boom and busts locally, as it helped some institutions take more leverage and fueling price cycles. And so that is something that you want to think about carefully in terms of not only the first moment of growth, but also the second moment of variance across the business cycle. And that is something we don't do, but I think it's useful and it's interesting to think about. I think it goes in this direction that you're saying there was something else that also was happening by the other banks that might also interplay with capital market.
Let me end with a slightly speculative question. We appear to be in a moment when virtually the entire regulatory structure of the, at least the federal government, is up for grabs. We can decide whether we like that or not. Given what you've learned from the history, are there particular insights from the study that you think are particularly important, that you would at least hope that federal regulators and policymakers might take into account as they sort of think about the regulatory structure for sort of the banking system going forward? Maybe, and if you want to focus a little bit particularly on mortgage lenders, since we're a housing center, but just broadly.
Yeah. So I think, there is a lot of work on macroprudential regulation, and Of course, like, you know, the literature shows how important it is in the light of the great financial crisis, especially. And, you know, part of the rationale, part of the narrative in the literature is like, well, the regulation really started in the 80s and the 90s, exactly what we're in the period that we're like, exactly after the period we're studying. Whereas before it was a relatively quiet period of the regulation. What we show is that even in the quiet period, things were happening, like banks were moving money, and it seemed a good thing. So I don't know what would be the conclusion for that. I think just this is a little bit different from what we're doing in this paper, but you know, the other paper that the Joint Center has helped me with is the paper with Ed Glazer on housing construction regulation. That also starts in those years. And it's kind of, you know, what we show is that it's not very good for productivity. So if, you know, any regulation, if moving towards an easing of regulation in construction is something that the federal government might think of doing, perhaps there are some silver lining. We can have, you know, very long discussions, and we can have everyone has its own opinions. But one of the things that we show is that one silver lining to think about when we think about the deregulation of construction on the residential construction is it might make construction firms more productive, because for them it's easier to scale up. It's a little bit different from banks, but I think, you know, it's probably in the...
It's all of a piece. Well, you know, as you were talking, I was just thinking that, you know, if you look at the Joint Center's mission statement, we sort of talk about wanting to do three things. You know, one is to generate new insights and really understand housing markets dynamics and you know, broader community development dynamics. And you know, this is I think a really interesting piece of work. It's different than, you know, our usual bread and butter, which is part of the fun. You know, the second is to try and encourage discussion of that through events like that. And then the third is, you know, the obligation that we have to basically try and support the next generation of leaders in this field. And the Meyer Dissertation Fellowship is really a flagship of that, trying to provide a little bit of support that lets doctoral students focus a little bit more on their writing and a little bit less on doing something else. I just have to say that I think that this is a presentation that really underscores the importance of all three of those things. And I look forward to following, you know, your career. You're clearly already making a huge contribution, and I expect to see it for many years to come, and we will claim a small share of that credit. So I hope everybody online will join me in thanking you for a really interesting presentation, and I hope that many of you will join us for one of our future presentations, and again, encourage you to look at those online. Thanks, everybody, and have a great day.
Thank you, David. Thank you so much.